How much federal tax do we pay when we're on a 72T payment plan? Hi, this is financial planner Sean Mullaney. Let's discuss. And early retirement is out there. People are talking about it. And there are going to be some people who are going to need to use a 72T payment plan when they get to a so-called early retirement. And so I want to explore, what do the taxes look like when we're on a 72T payment plan? And what might it look like from a premium tax credit perspective if we're on an ACA medical insurance plan? So I'm going to lay out just a hypothetical couple that's highly inefficient. This is Jeff and Ellen. They are age 53, married filing joint, and they started a 72T payment plan January of 2025. They want to live off $100,000 a year. That's, a pretty nice retirement. But they are highly inefficient. Look at their balance sheet. Paid off house, okay, fine. They've got the joint online savings account, just $40,000. And then Ellen has an $800,000 traditional IRA. Jeff has a $1.7 million traditional 401k. So the first thing they got to do is they got to set up their 72T IRA. And I've got the calculation here. I've talked about this on the channel before, so you can go back to that old video. But what they do is in January 2025, they look at the interest rate for November and December of 2024, the previous 2 months, and they look at the 5% ceiling that the IRS laid out in Notice 2022-6, and they pick the highest rate available. Among those three options, 5.03%. I've got a IRS website that proves that. Okay. Then they have to get their life expectancy. That comes off the IRS single life table. Fidelity has a PDF, I think, of that. So I got that for 53 is 33.4. And then the payment amount. Well, the payment amount is determined based on their own needs, right? Their wants, their needs. They want $100,000. Okay. So when you have interest rate, when you have life expectancy and annual payment, you solve for the size of what I refer to as the 72T IRA. I think some other practitioner probably came up with that, but I use that term anyway. So, okay, 1.62 million and some change. That's the size of the 72T IRA that can produce the $100,000 72T payment they want. How do you do that? Well, in Jeff's case, he'd pick your financial institution that you like, call them up and say, hey, I just left this job. I've got a $1.7 million 401k sitting over there at that employer. Can you help me do a direct trustee-to-trustee transfer of that old 401k to a new traditional IRA, step one? And then step two, once it lands at that financial institution in the traditional IRA, you do a little slicing and dicing. You slice the existing traditional IRA into two traditional IRAs. One is a 1.6 million and change 72T IRA, and the remainder, which is almost $100,000, just goes into a non-72T IRA. That could be used for later planning, different video. Okay, so now we have our 72T IRA. We take our first payment of $100,000. What does the 2025 tax return and taxes look like? Well, we can do a little spreadsheet, and it's actually not that difficult. I got about $4,000 of interest income because the existing online savings account earns interest. Plus, I have them take the $100,000, put it in their online savings account, spend it down evenly. It generates about $4,000 of interest. Okay, 72T payment, $100,000, taxable income, ordinary income. Okay, adjusted gross income then is $104,050. They get the standard deduction, the high standard deduction in 2025, $30,000 for a 50-something married couple. And then taxable income is $74,050. Look at this federal income tax, $8,400 and change by my estimate. The effective rate on that is 8.08%. Think about Jeff and Ellen. When they built up the 401k traditional IRA, they probably took deductions at 22%, 24%. So they seem to be winning. Let's go over the tax calculation. You say, well, I thought the lowest tax rate was 10%. How is their effective rate just 8.08%? And it has to do with the high standard deduction. Look at this. The first $30,000 of income is taxed against the standard deduction, 0%. And that shelters the $4,050 of interest income. Great. Zero tax on that. That's fantastic. And then it shelters part of the 72T distribution, $25,950. That's what I refer to as a hidden Roth IRA. It's a great concept, and it's available when we take money from a traditional retirement account and shelter it from income by the high standard deduction. Now, I'm not here to say 72T is the cat's meow, right? But I will say commentators who speak negatively about the 72T usually fail to mention this hidden Roth IRA phenomenon, right? We deducted at 22%, 24% into a traditional retirement account, and then we took it out as a federal tax-free distribution. I thought that was a Roth IRA. No, that's a hidden Roth IRA that lurks inside the 401k or the traditional IRA and then comes out as a 72T payment. Real advantage of 72T payments, few people are talking about. So, okay, that's the first part of the distribution, but we have some more. And that is $23,850 is going to be taxed in the 10% bracket. We've blown through that. Okay, we pay some tax. Level 3, we don't blow through the 12% bracket, right? So our 72T payment is subject to 0, 10, and 12% tax. It was probably deducted, like I said, at 22%, 24%. We're doing pretty well against Uncle Sam here, so that's really cool. Now, there is another consideration, though, right? So we say, okay, 72T plans, they're relatively lightly taxed in today's environment. But there is a second consideration for early retirees. It's Affordable Care Act plans and the premium tax credit. So recall, Affordable Care Act guaranteed issue, but they have high premiums, but you can get a premium tax credit to significantly reduce those high premiums. And it's determined based on two main factors. One is the percent your income is of the federal poverty level. And in Jeff and Ellen's case, it's about 500%, a little more. And the second thing is what's called the second lowest cost silver plan for their age and geography. And so all of this is speculative, right? I'm just going to give you an illustrative example of what the premium tax credit for Jeff and Ellen might look like in 2025, and then a couple comments about 2026. So for 2025, what you can do is you at home, right? You got to do your own analysis, but you too can go to the form A962 from the IRS, come up with your own spreadsheet. And you could use this as a guide. There's no guarantees, right? You got to verify what I'm doing. But okay, what you do is you figure out your modified adjusted gross income, and then you look at the federal poverty level for the previous year, and you figure out, all right, as a percentage of my household income, that federal poverty level is about 500%. What we do is we go to the IRS instructions to the Form 8962 or just to the Internal Revenue Code itself, Section 36B. That tells us that we basically have to pay something like 8.5% of our income in medical insurance premiums at this level of income. Oh, that's 2025. We'll come to 2026. So they're expecting an annual contribution of $88.44. And then they say, well, wait a minute, that's going to be a reimbursement of the second lowest cost silver plan for your age and area. I'm just going to use 700, right? These numbers vary, right? Just for this example, I'm going to use $700 as the second lowest cost silver plan for their age and area. 16. So when you do $700 a month times 2 people times 12 months, you get $16,800. And then their premiums, I've got it at $720, right? So maybe they're on a silver plan that's just a little more expensive, $720 a month. And we do the calculation, and they essentially get an $8,000, it's a little less, premium tax credit against those ACA premiums. And so they will pay $9,300 total because it's essentially reimbursing based on, like I said, their income, second lowest cost silver plan rate. They happen to be paying a little more. So, all right, so they'll pay they pay that delta. But okay, $8,000 premium tax credit, that's great. But in 2026, the result is going to be different unless Congress changes things. And I'm recording this May 2nd, and we're expecting the House Ways and Means Committee to issue bill text for a large proposed tax bill sometime in the month of May, right? We don't know exactly when, but it's coming probably sooner rather than later, but probably not too soon either. Probably not on Monday, but who knows, right? I've been wrong before. So under the existing law, this result would not obtain in 2026. They'd get zero because the 2026 law right now says at 400,000 or 400%, you go over that, you're done. No, that's a cliff, right? So it's interesting to me. It matters, but I also think sometimes we overemphasize this in planning, right? Premium tax credit absolutely matters. But this 8,000, if they were to lose it, it would be about an 8% surtax in this particular example, and it could vary wildly. So it wouldn't be good for them to lose it, but I also don't want to go crazy about them losing it either. Now, a couple like Jeff and Ellen might want to start off with a smaller 72T. 2025 is definitely a wait and see year, at least right now, because of this potential. Who knows? Maybe they will extend the current rules. Maybe they'll do some version of the current rules. So stay tuned. But I thought it was interesting to see that it's absolutely possible to pay a relatively modest tax on a 72T plan, as you see here. And especially it depends on your numbers, you could get a significant premium tax credit as well if you're on a 72T plan. So let me know what you think about 72T plans. Let me know what you think about premium tax credit. Let me know what you think about tax law changes that might be coming up in 2025. Thanks so much for watching. If you enjoyed this video, please mash that like button and subscribe to my channel. I will see you next time.